Hey everybody, welcome back. Time to go over. Let's jump right into it. So again, we have the doji and we're just sitting there from Friday. We're wedged in there. We know what's coming out. We know we have CPI. We're going to go through this and what to expect and how you can estimate where it's going to come in at. We're going to have to talk about why it's so significant, the Fed meeting, and we have to talk about what's going on in the bond market and then where that's going to take us. But we're just sitting right in here. So we broke out. This is a control bar, completely trapped everything. Then we're trying to break out of that control bar. Then we kind of get a little matumboed up there. If we drill into this on a 5-minute chart and just take a look, what really happened today? Not really a whole heck of a lot, did it? And so there's not really much to add on the fact of this is what we did. What'd you do? Well, we kind of went sideways, okay? I'm not really adding a lot of value from that, so we're not going to spend an inordinate amount of time on it. What I would do is just take a look at the NQ as well, and we'll go through that and just look at this. Well, we'll set that later. Let's take a look here and just dive into that. What do we have going on here? Well, we don't really have a lot. And we know why. We went over this on Saturday that, you have the Fed coming out this week and the chances of a cut change drastically. So they're going to want to see data. Now we have plenty of data coming out this week, plus the Fed, plus the dot plot, which we've gone over. We're also going to miss a huge buyer this week. And for time's sake, I didn't get into it on Saturday, but we're obviously going to have to address it today because it's a really big deal. But before we even get into who that buyer is and where they're going and why they're going to stop buying, we just have to look at what's really going on here. You have a flag, you have a high tight flag and it's sitting up there. Does the market rally after this because of equity risk premium? Well, that's a good question. It's something we should address tomorrow by looking at the equity risk premium. But what is this telling us? Nothing. It's telling you absolutely nothing. And then what did we see today? We saw the same soup reheated. And what do I mean by that? Well, we break out. People don't think tech's going to go. And then what does it do? Reverses, encapsulates everything and rips everybody's faces off. And everyone's saying it's too high. Meanwhile, Lam Research hits a new high. AMAT hits a new high. And you just go through those names. And what do those names have in common? They're all semiconductor capital equipment manufacturers. They've all completely encapsulated the top and they all broke out. They're huge reversals. And those huge reversals are taking place right in front of Oracle's earnings, which are tomorrow night. Now, I don't want to segue too much into that. We have a bunch of charts to go through, and I want to show you one kind of trade that's working exceptionally well for us in the community. But before we get to that, I think we have to just dive into this and go, what's going on with the dollar? Now, if we look at the dollar, you have that reversal, and we pushed. Now, let's just look at the most simplest of indicators. And you have your 12, your 22, they're pointing up. Here's your 55. I use a 12, a 22, a 55 simple moving average. You should use what you're comfortable with. If we overlay the 200, you're above everything. If the dollar was a stock, you'd be giddy looking at trying to figure out how you're going to get into it. Now, we have that, and we also have what's going on with the 10-year. And we look at the 10-year and this reversal. Now, we all know that this reversal happened. Why? Non-farm payrolls, higher than expected. We all thought we were going to break down. We were cheering. We were high-fiving the bros. And then we get the reversal, and this is what we're dealing with. We need to look under the hood why this is happening, and then we need to take a look at how you can look at the different sectors that should be affected by this and why they're not being affected the same way, to the point that an institutional investment firm today came out and wrote a whole piece on it. But before we get to that, it begins. And I want to address this. Now, we'll spend more time on it this week, but we have a lot to go on. So, estimating blackout begins 6/14 with 50% of the S&P corporates in their blackout period, assuming entry 4 to 6 weeks prior to earnings. As the estimates have come out, earnings estimates become actual. As the earnings window ends, which it usually ends right around when? Right around that date. This is the date I keep talking about that just happens to coincide with what? It's marked by AVGO's earnings. So this is really interesting because I'm going on the assumption, and you know what they say, never assume. I'm going on the assumption that the AVGO chart I went over on Saturday, I'll link back on this thing, that they're ending because AVGO is coming out with earnings, and for whatever reason, that is marking the top. Maybe AVGO's earnings are also correlated to when the buybacks are ending. And maybe that's the correlation, right? Remember, correlation is not causation. So it's very possible that the indicator that I'm looking at that's telling you what's been driving the market could just be these corporate buybacks are so big and much bigger, we'll go over this later, than anticipated. But this is really important because this is when the market dried up last time, and it just dried up last quarter right around the same time, and it's happening again. Understand that this is happening into CPI, FOMC, the dot plot, PPI, and Japan also coming out with their monetary policy. So this is extremely important, and I wanted to comment on this before we get into it. We'll get into more detail on it this week. Now, in regards to the 10-year, it's really important to get what's happening here and how this is affecting not only small caps, but also regional banks, and why it's so convoluted. Now, before we get to Fed meeting and why it's important, CPI, why it's important, we have to understand not only the data, but how it affects stocks. And so Morgan had a really nice piece out, and so I just want to share this. Now, this is obviously not mine. This is a piece directly from Morgan Stanley. And small caps underperformed last week as rates fell and as rates rose, okay? This is kind of interesting because what they're showing is it doesn't really matter. Either way, small caps, they're going down, like either way. And the question is why, and we're going to get to that, but they circle in this area specifically because you can see the drop in the 10-year, 10 years marked right up here, and then you can see small cap versus large cap performance, relative performance right here. And what they're doing is they're always looking at performance on a relative basis. And that's something that you'll see me do a lot in our videos. A lot of institutions do that, and frankly, it's how I was trained, so that's why I do it. I do think there's validity to it because what they're doing is they're comparing, is this sector, right, better than this sector? And if so, let's buy this sector versus this one. That's not the case here. And what you're seeing is like right up in here, what are we saying? We're seeing that yields going higher. And what's happening there? We're seeing the small caps drop. Okay, well then we're seeing yield drop. And as yield drops, what happens? We're seeing that drop. Okay, well then yield goes higher again. What happens? Well, small caps drop. So the question really you have to ask yourself is why, right? And this is connected to CPI before we get to it, which is then of course connected to the rate cuts. And we need a little bit of a battle plan, so we're going to go through one. But the economic data is really throwing us off. And they do a really good job explaining it on this graph. So economic data has been mixed with weaker growth and hotter inflation. So economic growth surprises. So this tells you, are we getting economic surprises what? Are they coming to the downside or are they coming to the upside, right? So there's a huge difference, obviously. If they're coming to the downside, then that means that things are getting weaker. If they're coming to the upside, that means things are getting stronger. If things were stronger and inflation was going up, you'd go, oh, when inflation, for lack of a better term, is dropping, and at the same time that this is dropping, that this is going higher, well, that's a pickle. And the question becomes, how long does that go on for? Because we don't want that. This is sometimes people refer to stagflation. I don't really care what you call it. It's just not good. When you have surprises like this, but things are getting more expensive, eventually something's going to break. Either the growth is going to change or the inflation is going to change. It's just really a question of what. But it's important to get this when you're going in the CPI and the Fed, because they're going to have to address this, especially with the dot plot. And we'll talk a little bit about that as well. And then they run these relative scans, and I'll show you how to run these relative scans as well. But equal weight S&P and regional banks are also making new relative lows. Now, what does that mean? So you take the equal weight S&P and you divide that by the S&P. I'll show you how to do that. And then you take regional banks, which are KRE, and you divide that. And what this will show you is it's showing you over the course of the past 2 years what's going on. Well, you have growth fears. They're increasing and we're dropping. And then when growth fears decrease, we're rallying. And it just shows you how they're trading hand in hand. So hand in hand, the equal weight S&P is rallying when regionals rally. And I think that's really important to get. So these things are stepping in tandem, and that's what they're showing. So they're showing the equal weight of the S&P, the small caps versus the S&P as well, and then regional banks versus the S&P. And what they're doing is they're showing them in tandem. Now, for me, understanding that small caps, right, small caps here, and then you're also looking at regional banks, well, that's going to go that way. That makes sense to me because small caps, 15.9% of the Russell is finance in one way or another. So that kind of makes sense that you're going to see that continue. But as you start to go through this, there's more important data such as trailing earnings growth is turning higher, driven by margin improvement. Well, if inflation's going higher, right, which it is, and growth is coming down, how are they getting margin improvement? And so the title of this entire piece, and what was so fascinating about it, is he's just basically coming out and saying everything's really, really, really confusing. And I do agree with that, where you have sales that were just absolutely exploding here, and you can see that, right? But now they're coming down. Sales are coming down. Earnings per share is going up, right? But at the same time, that's due to margins getting better. But sales are starting to level off. So a lot of this, when you start to try to wrap your head around it, doesn't make a whole heck of a lot of sense. Because net margin's going up, but sales are dropping. So as sales are getting weaker, the margins are doing better. It doesn't make sense. And so that was the point that he was trying to get to, and I want to allude to that as well, because this is going to throw off CPI to some extent, right? So the question was, if you had sales and sales are stagnant and then your margins are going up, how could that happen? Well, the cost of the goods that you're buying, PPI, which is what they buy, right? And they sell to who? Us, CPI. The cost of those goods must be dropping, or else margins are not going to get better, because you can see sales are not getting better. So it's got to be the cost of the underlying goods is getting better. And then this is really important before we dive into it and how we could talk about these Fed cuts and what to expect. And again, just real quick, S&P performance of historical mixed posts started the Fed cut. All right, they go to 73 when you had a Fed cut. And all we keep hearing about, is when they cut, that's when you got to get out of the market. Okay, you dropped 0.5% on average since 73. You made 2.9, you made 3.3, you made 3.5, but everyone will tell you to get out. Here's the actual data. Now, what we want to do is look and say, where's the data where you actually had increased productivity? And this is really simple. And you can go back and you can go look at this for yourself and go look at increased productivity during these periods of time if you want. But there's really only 2 times where they have cut rates since 73 where you've had increased productivity. And it was 81 to 84 in here, and you were coming back off of 80, but yep, you still went down here in that area. And then you would have 95 to 98. These are the only areas you can really compare where you've had increased productivity and they cut. The difference is if our productivity dropped, well, then all bets are off. Then you could be looking at an 01 situation or an 07 situation. You could be looking at that. That is possible. But right now we have increased productivity. Nobody is going to state that we don't. That's part of the issue. And with AI and the revolution that's going on there, I've been saying for about a year and a half now, it's very similar to what's happening in 95, 98. But at the same time, yeah, let's say productivity does change. Well, now we could be in an 01 or 07. It's important to get that distinction. Now that you understand that, let's look at the CPI, what we're expecting, and I'm going to show you a real quick back of envelope way to see how this is going to play out. Now, before we get into showing how to figure this out, let's look at what we're trying to figure out. So core inflation, core, that refers to X food and energy. They take out food and energy. They're not included in anything core. And what you're going to see here is consensus 0.3. So they're expecting the month over month core to be in line. They're expecting consensus overall here to be a little lower on core. On the month over month, they're expecting consensus to plummet month over month. And then they're expecting the previous, obviously, stay here, and obviously maybe that'll be cut, but who knows? This is what's always fascinating to me, and it shows me that something's off. Month over month is going to drop, but year over year, for some reason, is going to stay stagnant. It never really makes sense to me. I could see how the month over month would stay stagnant, but year over year would stay stagnant. Doesn't make any sense. So again, one of these has got to be off. We're going to get into which one I think is going to be off in a second here, but what we need to know is this is what we're dealing with. Now, we've been hearing higher for longer, and that's just not accurate. We need to discuss this. So really what it is, this is CPI year over year. And what we should be focused on is this. This goes back to obviously May 23 right in here, right? And what we would do is, well, then we peaked and then we dropped. Well, we dropped immediately, and then what did we do from here on up? Well, we just went higher and higher, and then we dropped again, okay? And then we peaked, and then we dropped. Now, from 24 on, if you were to look at this, all you've done is it's not higher for longer, it's just higher. That's all that's happened. Now, you have a 3-4 here, which is good. So you are seeing a little drop here, right? But what we need to see is we need to see a substantial drop. So I'm going to show you a back of envelope way that I do this, and then you can take this for what it's worth and see if you can get some value at it. But I found it pretty accurate over the years of doing this. Now, in front of us is very simply just, now if you look at oil, everyone would say, well, that's not going to be everything. And I understand that. But if I come here, let's get rid of this tool for a moment. We'll use this tool. And again, comment on this. It does help me create content if you think that this is helpful. But if you go back and look at all these videos, and I don't delete anything, if you go back and you take a look at this and you go, all right, here's January. And then we get into it and go, okay, well, here's the end of January. Right. And you go look, well, was CPI higher? Yes. Well, at the same time, if we come here and just measure off, it was higher. Okay. So you know you have a hot number coming in on crude. You know that crude and you know that oil is in everything. And then you also do this over again with, I like to do this as well with taking a look at gasoline because there is obviously the crack spread. But again, you moved up a little bit incrementally there. And again, what happened with CPI? It was up. And then you just kind of go here and you go, okay, well, here's Feb 28th, and you go to March, and then you would go, well, March to here, we were up again. And so if we look at this, the graph that I just showed you, you were up all three. And then you go to April, and then you go to April 30th. And then you would go, okay, well, from here to here, we were down. Well, what was the first month that CPI, you can go rewind the video, what was the first month that you were down? It was that month. I think that this is the easiest thing to do. Oil is in everything. Everything, from medical supplies on, things have to be transported. And that's also why I'll do this with gas. But the easiest way for me to do this is to take a look at this. Now, what's also fascinating is you'll notice that Biden stopped with the SPR. But whether they mark us here or they mark us here conveniently is that we had just happened to have that drop at the end of the month. But I'm not gonna put my tinfoil hat on right now. But if you drop and take a look here, well, that's a substantial drop, right? And we're just using the end of the day. I'm not even using this. That's a substantial drop in crude oil. Therefore, I would think that the number comes in light. And people say, well, it's just not that simple because you have to look at, medical supplies and medical costs. Everything costs. Everything costs. If you're going to hire a nurse, she has to drive to the house. Like, everything costs. And if you look at it from that way, and if you mark this off just very quickly doing it the same exact way here, and you just marked off January on, and you just went through it that way, you'd see the same thing. I'm not going to do it all for time's sake, but you'd see the same thing. But take a look at where we go and take a look and go, okay, well, here's May 1st is right here. And then go take a look at May 30th and where you're at. And you're going to see a huge drop. And to me, it goes from the beginning of that date to the end of that, wherever you closed, which is right here. And you have a 10% drop in gasoline during that period of time. I find it really hard to believe that that is not going to be shown in what we're looking at here. I think it's going to be. Also, you have to remember GDP came in significantly weaker than expected. Now, for time's sake, we'll do it this way, but this is just GDP by the Bureau of Economics. And you're just have to look at these levels, and obviously they're going to only mark the quarter. But you start looking at these turns and how you're dropping from that quarter versus quarter, and then this data was released in April. Look at this and look at what's happening here. And we came in at 1.3, I think is what it was. I think they released it like early May, actually. And so you're getting that 1.3 kind of number that they're looking at right now. So this is actually falling off a cliff. And that kind of makes sense of why pricing would come down. So this is what we're going to look for. Now you kind of have a game plan on where my head is. Let's take a look at some charts. So we should cover a couple of names. Let's start with NVDA, and I'm going to follow through on a trade. So what we saw here real clear is we just saw the doji. It's a little out of whack, and I think that's because of the 10-for-1 split. If we dive into this on the hourly, we'll not see it there, but we had a really nice trade in this today. Very simple trade but just a very simple process. But give me a second here. Let's clean this stuff up a little bit and just go to a bear chart. And I do think there's a couple things going on here just on the hourly that are worth noting for tomorrow. Again, I'm a big believer in control bars. I'm watching where the buyers and sellers are of such bars. If you would think that the entire range that you're dealing with on NVIDIA has come down to one hourly bar that you can no longer break or break out of, I think that's significant. And I think we'd be remiss in not looking at it, because when you take that and then you overlay those areas, you can see that they become an area of interest where we take that control bar and break it down to the minute, and you can just see entry after entry. And even when you break it, you just find another spot that could become an entry. So we had a really good trade when it broke down here today. We knew the significance of the level, and then we saw what we wanted, and we just overlaid it with what we do in an educational class. But you can see right here pretty clearly, I'm a big believer in RSI, and I use RSI a lot, as well as some other indicators. But when we saw this today, it just made super sense to try this because it's been working so well for us lately. People say that RSA doesn't work that well. I just don't think they know what they're doing, quite frankly. But again, I use different metrics. My metrics are different than just the standard. But you can see the reversal pretty clear here. You have a bullish engulfing. You have here, and you have some other indicators. Let's watch it play out live. You're at support for NVIDIA, so that's not great. See if you hold that support. You're probably going to go right through it, looks like, right? So just letting it go. I'll find a spot to add to it later. NVIDIA is giving me no indication to buy yet, zero. So if you took Saturday's class and you know what a control bar is, you might be getting a little giddy. Oh, wow, I can buy thousands now. This is fun. Hold on. Buy more over here too. More for everybody. I bought NVIDIA if you didn't figure that out. Just off that move. If it takes out that low, it cost me $1. If you did that for the day trade, you got to be pulling money out, guys, especially as you get up to here, right? You're going to just have to start getting in that habit of pulling money out and going from there. So up here, it was up like about $1. I really haven't done anything with it yet. Maybe if it makes a doji and it breaks the doji, I'll kick half. So NVIDIA held. There's so many things lined up for that trade. It's silly, right? By the time everyone's waiting for it to flip VWAP and everything, we'll be selling it to them. NVIDIA looks like you're going to break VWAP. So you can see why those control bars are so important. So right into this, I'm going to sell some. So if you just did it for the day trade, you got to get out. You have to trim. I shouldn't say get out, but you want to trim like when you can, right? And there goes NVIDIA over VWAP up 2 on the day trade. So I'm going to trim. Whoever was selling at the open, you're back to that. If you haven't trimmed, you certainly would want to be trimming here if you haven't trimmed any because you just rejected the open. Patience pays, guys. See it? Everyone's getting all giddy. All I do is have a little patience. Found a perfect spot. This trade worked perfectly with the RSI trade, worked perfectly with the ATR trade, and you got in before everybody else. So I hope you found that helpful. I got a lot of comments to keep showing live trades that we do in the community, and then you can look at those processes and overlay them for yourself and take what you want from those and see if that's of value to you and if you can do that yourself. Also, someone's helping me cut these live trades out and turn them into mini lessons. So you'll start seeing those pop up if you want to subscribe to the channel. Click all notifications because they're going to come out randomly. When they're done, we're just going to put them out there. No specific time, but the only way you're going to see them is if you click all notifications. Or they'll just hit your feed, I guess, but you just might want to see them again. So I'm trying to chop them into like 8-minute clips so that you can go back and rewatch them and not go and look for them. Anyway, it was a comment that was out there and I thought it was a great idea and I think it'd be helpful. So again, what you're always drilling down is to like the least common denominator, right? So this goes to a 30-minute chart and you can see that that's the control bar that you cannot break out of. And then you would just keep drilling into that bar over and over again. So I would watch this tomorrow and see what happens. We're going to have the light volume, obviously, because of what we're dealing with. And I think that's significant. People are starting to realize that AMD is really a pig. I don't think that anybody should really be overly surprised by this. But again, the downgrades are pretty simple. They're being downgraded because their products are not able to compete. And no one's really going to come out and say that for a bunch of litany of reasons I'm not going to bore everybody with. But down, up, 1, 2, 3, down. If you know rising 3, falling 3 patterns, you really want to pay attention to that. Is it a perfect one? Nope, but life is not perfect, as we all know. But when you see it, you want to pay attention to it. And here's your control bar, and you are wedged in this spot, guys. So you want to watch this really closely tomorrow, because if you break, and it looks to me like you're finally breaking, you are now below the 55, you are now below the 12, you're now below the 22. I use a 12, a 22, a 55. You should use what you're comfortable with. Are you going to get the juice to sell before the Fed meeting? I don't know. I don't have a clue. But it's there. You might want to watch it. I mean, that's really how I look at it. I think what you need to look for is what is bouncing, right? And we shouldn't be surprised by some of this stuff, but some of it's kind of shocking. So I did this trade today and I did really well with it, surprisingly. And candidly, I didn't think I'd do that well. But the way you curled here, and one of the things I like to do is just measure these bars with a 50% line because you can just see where you're at. And for whatever reason, it's not lately showing that little trend line bar. I'm not really sure why. Maybe if I pop that in, why? Oh, you're putting that there on the long side. That's not really what I need, is it? So I'll have to figure out why that's not working lately. But for whatever reason, it's not marking off those levels. Used to mark them off just fine. Oh, maybe this will do it. Maybe it's coordinates, visibility. I don't know. For whatever reason, extend lines to the left. Oh, there you go. Who's a winner? I am. All right. So there it is. And you can see that line right in there now. And look at how that flipped. I had the number written down. I'll remove this. If you remove this, yes, please remove it. So you can see how you flipped and how you broke out right from that level. You always watch these 50% demarcation lines. And it's the simplest reasons why. Well, this is a bar. Anything below that level is probably selling. Anything above that level is buying. Look how you fought that 50% line. It's not a fib, but it's just an easy way to lay it out. And once you started lifting, we just bought it over there. If you took it, you did great. If you didn't, you didn't. And you don't know which one, like, let's be really clear about this. You don't know in this market which one of these is going to push. Because you could have looked at A and F and said, that's not going to push. And you could have looked at ELF and said, that one's not going to push. And then you look at both of them and go, hey, they both pushed. Why? They're going after retail, beating down retail names. And I would continue to focus on those. The one that I keep watching and it's on my radar, and I'm showing you these because I think it's really important that you understand that they're rotating out of certain names. But like the Altas of the world, right? Like that's interesting. And if you know that you have a buyback coming up, like one of the largest buybacks out there, you might want to start watching that, especially since corporate buybacks they're going to get into that halting period, right? So you might want to understand what's been driving these stocks. I think that's really important, right? Because you also have Meta that has that huge buyback. And are they trying to get it in before they hit their blackout window? I don't have an answer to that. But that's a heck of a move on Meta today, isn't it? And the other ones that I think look pretty good are the Netflixes of the world and how they held that 22. I don't know that we're going to get the volume that we need to push here going into this, right? I will say this, that I thought that this was pretty interesting as well. MEXX, undercut, and then bounced. So this was something we talked about in the pre-market. And I do think that I should move these. I keep them in different colors, and then I move them to where I think they should be. But I think when you look at something like this, this might be washed out. This looks like an undercut and then maybe a push tomorrow, right? So this might be worth watching. But I also think that when we're looking at some of these things, we have to realize that the skew, which we talked about, is shifting. So then you're seeing names like VST, and they're pulling back to their 55s. CEG, look at how this pulled back as well. And so these are all the independent producers. They're all holding. It's always so fascinating because everybody always wants to buy like Argentina when Argentina is running. When Argentina's falling down, you don't hear it anymore. And all these pulled back to where? The 55-day moving average, right? All three of them. I use a 12, a 22, and a 55. You should use what you're comfortable with. So if we look at it from that perspective, right, and you overlay all this, like take a look at Crocs. You have people out there telling you to buy Crocs. Who wears Crocs? Well, I bought a couple pair. I'm not going to lie. We'll see what the big fuss was. I still don't get it. But if you look here, you held the 22 and you had the 12. So you are seeing a rotation into these names. And I think that that is significant. And I think it's something you want to pay attention to. Now, I don't know what to expect tomorrow. I think you're going to have more light volume. I do think that people are trying to get ahead of this Oracle quarter. You know, the rumor is that Morgan is out there telling people they're going to have a bad quarter. I don't know, but something sure as heck happened right here. Something definitely happened where people felt that they had some kind of edge. And it's always the same thing to me. It's always reflective in some kind of control bar. If you are on the wait list to get in the community, a new batch of invitations will be going out shortly, and link is in description. If you are on there, just look for it. But look at that bar. There's your control bar on the day, right? And then what happened when you broke it? That was it. This bar is now in control, and we've just completely rejected. You came up to what was support, got matumboed, rallied into the end of the day. But also, we did not have this huge amount of buying at the end of the day, did we? We just didn't really have that kind of oomph. If we go and take a look at, it doesn't really matter what we look at, but pull it here and look at the volume, and you'll notice that. Watch. All right, at the end of the day, we had this, but you don't have a lot. Like, you didn't really like knock the cover off the ball here. And I think that's telling. I think people are just staying out of the way until we see CPI. And CPI, frankly, might be more important than even what the Fed says. But I don't think it's going to be more important than the dot plot. That's it.